Hello everyone and welcome back to another video. So Netflix stock is down roughly 3% today after they reported their fourth quarter earnings results, and Netflix is also down roughly 37% from its all-time highs. And many of you have been asking me for my thoughts on Netflix's fourth quarter earnings results and if the stock is looking attractive today. So that is what we are going to be discussing in today's video. Now, full disclosure, I do not own any Netflix stock today, but this is a stock that a lot of my audience watches, owns, and pays attention to. So it is one that I follow here on my channel as well. So with that being said, let's now hop into Netflix's fourth quarter earnings results. And I want to highlight all of the good and the bad that I found and try to give you as objective as an opinion as I possibly can. And as always, I went through Netflix's earnings report and found all of the highlights that I think investors need to know. So let's dive into those now. This first screenshot shows that for the full year of 2025, Netflix grew its revenue by 16% year over year, or 17% on an FX neutral basis. The company also posted an operating margin of 29.5%, which is up 3% year over year, and ad revenue rose more than 2.5x to over $1.5 billion for the full year. In Q4 specifically, revenue increased by 18% year over year, and they crossed 325 paid members. Operating income was also up 30% year over year. They then say that in the second half of 2025, view hours increased by 2% year over year, driven by a 9% increase in viewing of branded originals. So right away, the fourth quarter earnings results seem pretty awesome in my opinion. Revenue grew strong and operating margins and operating income is up very well. Total members also grew by roughly 7% year over year as well, which I do think is good. But one potentially bearish point here is that Netflix's total view hours only increased by 2% year over year, while their membership again increased by 7%. This ultimately means that the view hours per member saw a slight decline on a year over year basis. Or in other words, on a per person basis, people are not engaging or watching Netflix as much as they were last year. Now, another potentially bearish point here is that Netflix once again saw their members grow by 7%, but their revenue increased by roughly 17%. This means that the majority of the revenue growth was from their average revenue per user, or their prices, increasing. And it was not mostly due to more people signing up for Netflix. And the reason that this is potentially bearish is because you have to ask yourself, how high can Netflix get their prices before people ultimately stop churning? And this is a potential problem with every business where the vast majority of their revenue growth is coming from increasing prices, because you cannot increase prices forever before you start ultimately losing subscribers. So the ultimate question here is, how high can Netflix increase their subscription prices before people start churning more? Now, I was doing some research and I found that the average cable subscription is somewhere between $50 to $60 per month, which is well above what Netflix is currently charging. So I do think that Netflix does have a lot of untapped pricing power that they can still leverage and use over the long term to continue growing the business. But it is worth noting that this is where the majority of the company's revenue growth is coming from. And personally, I do think that they will hit a wall eventually. And this is because I am a Netflix subscriber, but I also pay for Amazon Prime, Paramount, and Crave. And if every single one of these subscriptions were charging me $50 per month, then I would be paying $200 per month for streaming services, which would cause me to become much more picky on which ones I ultimately choose. Currently, at least for me, they're all at a price level where I'm happy to pay for all of them and I don't really think about it. But if all of their prices started to increase dramatically, then I would again be much more picky. And maybe I would subscribe to Paramount when they launch a show that I want to watch, and then, I'd watch it for 2 months or whatever, and then cancel my subscription. And I think that people would do this with Netflix as well. Maybe subscribe to Netflix if a new show comes out that they want to see, and then cancel once they're done watching that show. So that is the risk with the majority of the revenue growth coming from pricing power, in my opinion, and that is potentially a bearish point here. But getting back over to my Netflix screenshots, here we can see that they are continuing to work towards closing their acquisition of Warner Brothers, which I did explain at length in a previous Netflix video, and my opinions on the Warner Brothers acquisition. They also say that they're sustaining healthy growth, and they forecast that revenue for 2026 will be between $50.7 and $51.7 billion, which is roughly 13% year over year growth, with ad revenue expected to roughly double and their operating margin to continue expanding to 31.5%. So Netflix is projecting to grow its revenues by roughly 13% in 2026, and I do think that this is probably the main reason why the stock sold off after the earnings report, because this is a deceleration from the revenue growth rates that they have seen over the previous years. So let's head over to their yearly revenue growth. And overall, we can see that the growth rates have been decelerating over the past few years. But in 2024, they had a 15.7% year over year growth rate. And then we just saw that in 2025, they had another 17%. So 13% revenue growth in 2026 would be a continued deceleration to Netflix's overall business. And again, I personally think that this is the main reason why investors were selling off the stock after this earnings report. But let's move on to the next screenshot, which shows us a table of Netflix's metrics here. And here we can see that year over year revenue growth was 17.6% in the fourth quarter versus 16% revenue growth in the fourth quarter of last year. This means that for the fourth quarter, Netflix did see their revenue actually accelerate, which is a great thing to see. Their operating margin for the fourth quarter was 24.5% versus 22.2% in the fourth quarter last year. So their operating margin did expand by roughly 2.3%, which is good as well. And free cash flow was also up roughly 30%, which is also great to see. Now, for the first quarter of 2026, they are expecting 15.3% revenue growth, which is still above the 12.5% revenue growth they saw in the first quarter of last year. So they are still seeing their revenue growth rates accelerate. At least that's what they're projecting for the first quarter of next year. They're also projecting their operating margin to continue expanding to about 32.1% versus 31.7% last year. So operating margins and efficiencies are projected to continue growing. Earnings per share in the first quarter of 2026 is also projected to be up 15% versus the first quarter of 2025, which I do think is great to see as well. And Netflix is projecting to see its profits continue to grow by double digits. Now, this next screenshot has a lot of highlights, but the first few we've already discussed. So starting right here, Netflix says, with our strong Q4 results, we met or exceeded all of our full year 2025 financial objectives. And I always like to see when a business is beating their own guidance. And it also suggests that Netflix could maybe outperform the guidance that they set for 2026. Then they say, we also made great progress growing advertising revenue. In 2025, which was only our third year selling advertising, ad revenue grew by more than 2.5x versus 2024 to over $1.5 billion. So Netflix's advertising revenue is growing very quickly, and this is most likely very high margin revenue. So as Netflix's advertising revenue continues to grow, then I do think that their operating and profit margins will continue to grow as well. This next screenshot goes over Netflix's 2026 outlook once again, and we already discussed the top half, but down here Netflix says, we still see plenty of room to increase our margins, and our intent is to grow our operating margin each year. Although the magnitude of our margin expansion will vary year to year as we balance reinvesting in our business with improving profitability. This is Netflix saying they believe they can continue to grow their operating margins over the long term, most likely through continued pricing power and increasing the price of their overall subscriptions, while at the same time growing their advertising business, which again is most likely a high margin revenue stream. Moving on, this next screenshot talks about competition, and here Netflix says, we have long stated that we compete against all activities people engage with during their leisure time, including, but not limited to, other streaming services, linear television, social media, open content platforms, video gaming, and concerts, just to name a few. Now, why this is interesting to me is because Netflix is now trying to say that they compete with pretty much everything that people spend their time doing outside of work, like playing video games, watching any streaming service, and even going to a concert. This is stretching it a little bit, just in my opinion, and I think Netflix is doing this to try and have a better chance of acquiring Warner Brothers. Because the main argument against Netflix acquiring Warner Brothers is that they would create too monopolistic of a company with those two businesses being together. So Netflix is now saying, well, hey, we're not just competing against other paid streaming services like Amazon Prime, Paramount, and Disney Plus, but we're actually competing against YouTube, concerts, video games, and everything that people spend their time doing. And again, I don't necessarily think that this is true or genuine, because if that's the case, then Google search is competing with everything that you possibly use to search. Like when you go to Amazon and search a product in Amazon's top bar, then that would be considered a Google search competitor. That's kind of the logic that Netflix is trying to apply here. Personally, again, I just think that this is a little bit disingenuous, and I don't think that Netflix is competing with video games or people going to concerts or people playing basketball or hanging out with their girlfriends or their wives or their significant others, because that's kind of what they're suggesting. So I thought that was a little bit interesting. And I just wanted to point that out. And again, I think Netflix is doing this to try and increase their chances of being able to acquire Warner Brothers. Now, the next point that they make in the screenshot is that their US TV screen time is at 9% market share now, and it did grow slightly year over year. However, they also say that linear TV still comprises 40% of US TV market share. And this is the market that streaming services are still disrupting. And I do have a graph that shows this. So, all the way back in December of 2024, broadcast and cable made up roughly 45 to 46% of US TV screen time. And we can clearly see that even just over the past year, they have lost a significant amount of market share and are now down at 41.6%. Now, back in December of 2024, streaming companies as a whole had 43.3% market share. And in December of 2025, that grew to 47.5%. So streaming took 4.2% market share just over the past year. So people are clearly streaming more and choosing to watch streaming services instead of typical TV. And this is really the main tailwind behind Netflix's overall business and streaming companies as a whole. This next screenshot shows that Netflix has second market share in the streaming services, right behind YouTube at 12.7%, at least as of December. Amazon Prime has also grown to 4.3%, which I believe is one of the highest that I have ever seen them at. So Amazon Prime is continuing to take market share as well. In November of 2025, you can see that Netflix wasn't in second place though, and Paramount was actually doing very well in third place at roughly 9%. Walt Disney was in second at 10.5%, and YouTube has been number one for quite some time at 12.9%. Then you can see that Netflix was all the way in fourth place at 8.3%. And in my opinion, it seems like many streaming giants across the board are continuing to take market share from the smaller companies in the streaming industry. I have another graph that I found from Leverage Shares, which shows the different companies and their overall stream time market share. And we can see that Netflix has been slowly uptrending, but they have been kind of volatile. And overall, the market share has remained between about 8 to 9%, which is good to see because they're holding their position and slightly taking market share. But Netflix is not taking massive market share in the US streaming industry. We can also see that Warner Brothers has been losing quite a bit of market share over time. And I think that investors could be viewing this as a bearish thing for Netflix because obviously Netflix wants to acquire Warner Brothers, and Warner Brothers has been consistently losing market share. So Netflix basically has to be able to turn around Warner Brothers' business successfully. Now, the other things that I am noticing on this chart is that other competitors are maintaining market share pretty well, and that YouTube is the clear winner that is continuing to take market share consistently in the US TV streaming space. But overall, I think that Netflix is doing good, maintaining its position and gaining slight market share, but it does seem like others are doing better than Netflix is. And that's just what the data is suggesting here. So now let's try to answer the question on if Netflix stock is looking undervalued today. And here we can see that Netflix has historically traded for an average price to EBITDA of roughly 12.75. Now today, after the most recent earnings report, Netflix is trading for roughly 11 times EBITDA, also factoring in the recent stock price dip, which does mean that Netflix is trading below its historical average price to EBITDA multiple. However, if we also add an EBITDA to this chart, then we can see that Netflix's EBITDA has compounded by roughly 22% annually since 2016. And personally, I do not think that Netflix is going to be able to maintain these very high growth rates going forward. Now, the way the stock market typically works is the faster that a business is growing, the higher price multiple its stock can command. So if Netflix's EBITDA growth rates do decelerate from the 22% that they have historically seen, then it could suggest that the stock should trade for a discount to how it has historically been valued. At least that's what I think. And going forward, I do think that Netflix's overall EBITDA will grow in line with revenues at roughly 13% annually. And the reason for this is simply because Netflix's EBITDA margin has been very consistent over the past decade. Its median has been roughly 63%. It has been growing slightly over the past decade, but still it's been pretty consistent around 63 to 66%. I know that a lot of people like to use the operating margin or net margin for Netflix, and you can clearly see that Netflix's operating margin has been growing over time. But when I am valuing businesses, I try to find the most consistent profitability metric for that company because I think it gives us the most accurate view as to how the company is being valued today relative to its history. For example, if I try to look at Netflix's historical price to operating income here and compare that to today, then we can see that it's kind of been all over the place. It was literally 200 in 2013. And I don't think that you can gain very accurate insights into how Netflix is being valued today versus its history. But when we take a look at its historical price to EBITDA, since the EBITDA margins have been much more consistent, then we get a much clearer picture as to how Netflix's stock has been historically valued and how its valuation today compares against its history. Now, the last thing that I want to do is run a quick discounted cash flow calculation on Netflix's stock, and we're going to be using its EBITDA for the reasons that I just described, and projecting its EBITDA growth over the next 5 years. Now, in this DCF, I say that Netflix will be able to continue growing its EBITDA by roughly 13% going forward from here, and trade for an 11 price to EBITDA multiple, which is slightly below the company's long-term average of roughly 12.75. Again, this is factoring in some slight multiple compression due to lower growth rates going forward. And with these inputs, we get a fair value of $91 per share, which is roughly 9% above where Netflix is currently trading, and a compounded annual growth rate to the share price of 12% if the stock was purchased today. So in my opinion, I do think that Netflix stock is trading right around fair value today, or even slightly below fair value. But I don't think that this is like a drop dead price for the stock or that it is massively undervalued and that I need to run out and buy it today. Netflix is also a fantastic and high quality company, and I don't think that people buying the stock today are going to see low or negative returns from here. I just don't think that there is a high chance that the stock could produce exceptional returns from its current price, like 15 to 20% annually from where it's selling today. And that is the main reason why I am not rushing to buy the stock, because I am aiming for 15 to 20% annual returns on my own portfolio over the long term. And I do think that Netflix has some more falling to do before it could offer that type of returns with a margin of safety. And that's really what it comes down to, is that I think Netflix is trading for right around fair value today and could offer a slight market beating return from its current share price. Now, the reason that I think Netflix stock has fallen roughly 40% from its all-time highs is simply because it got very, very expensive at its peak. If you take a look at its price to EBITDA multiple, you can see that it was trading right near its historical peaks for price to EBITDA. Or in other words, it was trading right at the top of its historical price multiple ranges. And that is why I was avoiding the stock and also saying that I thought it was pretty expensive. Now it has corrected and is trading below its historical averages, which is also another reason why I think the stock is looking potentially selling for fair value or slightly below fair value. But that is my opinion on Netflix stock today. And if you did enjoy this video, then please remember to leave a like on it. And if you want to see more earnings analysis like this, then make sure to subscribe to my channel if you haven't already, because during earnings season, I try to get as many of these videos out as I possibly can and cover my thoughts on all of the big tech companies and the companies that investors follow. Now, lastly, if you're interested in getting access to my full portfolio, my Discord community, and supporting my channel even more, then consider checking out my Patreon subscription. I also recently started doing live streams over at my Patreon. We've done 2 already, and each of them have been about an hour and a half long. And so far, the reception has been incredible. So if you want to get access to my previous live streams and all of my future live streams, then once again, check out my Patreon. People have been loving it, and I think that you will too. But with all that being said, that is going to wrap up today's video. And as always, thank you so much for tuning in. I truly do appreciate it. And I hope to see you all again in my next video.